Volatility is a term I use all the time in my morning live stream, Coffee and Crypto, but I've never had the time on stream to really dive into what it is and its importance. Bitcoin has been called the most volatile mainstream asset class in the world, but what truly does that mean? I'm Jeb, and in this episode of Why Bitcoin, we're discussing volatility. You may have heard the word volatility used in a context outside of trading, and I actually want to start there. You may have heard people say something along the lines of, he's just too volatile to take on any real responsibility, or my friend does not drink anymore because it makes him too volatile. These actually translate into trading quite well. Volatility, defined by Fidelity Investments, is the rate at which the price of an asset increases or decreases over a particular period. The more an asset increases or decreases in value, the more volatile it is. Volatility in asset markets is usually the result of an event or a change in underlying sentiment towards a given asset or class of assets. So just like a friend may act erratically just because he's had too many whiskey shots, assets can become more volatile after too many headlines. Let's kick off our exploration of volatility by first noting that volatility can be used to describe an uncharacteristically rapid increase or decrease in the price of an asset. For example, every day there are pharmaceutical companies that experience volatility when the market rapidly changes the value of that company by 20 or 30% in the span of just a few hours. Pharmaceuticals are a fantastic example of a volatile asset class because the nature of the business model heavily relies on the approval of one regulatory decision from the FDA. That one decision then signals to the market whether or not that company is going to be able to make money selling a drug or not. Immediately after the FDA releases their decision on the safety and efficacy of a proposed medication, the stock price of the company will either shoot up or shoot down, most commonly by more than 15% in a single morning. That's volatile for most traders who consider a total gain of 1% of their entire portfolio to be a great day. Traders fully expect their investments to be subject to price movements that most other traders would find very extreme. Why they would choose to do this is a subject for another video, but rest assured that there are traders that live very comfortably from doing nothing but trading the volatility of pharmaceutical stocks. We're getting to Bitcoin, don't worry, but before we do, I want to linger in the stock world for a moment longer to examine a case study in extreme volatility. The stock market crashes of 1929 and 2009 were among the most devastating displays of volatility that the world has ever seen. The October 28th and 29th crash in 1929 experienced losses of 24% in the Dow Jones Industrial Average. Losses of 24% in 2 days, in fact, is what caused that Great Depression. From the 12th of August 2008 to the 9th of March 2009, the Dow Jones Industrial Average fell by more than 43%. This was a market crash that caused 3.1 million Americans to file for foreclosure on their homes. For a mature and developed market like the U.S. stock market, to deviate more than 10% in a single year is out of the norm. But 24% losses in 2 days, or 43% losses over just under a year, have significant consequences on the global population. There are many more cases of extreme volatility in assets such as oil, gold, and even fiat currencies, but now that we have some context for what volatility is and how it has affected widely adopted markets in the past, we can dive right on into why Bitcoin is more volatile than other popular assets. Some of the main causes of Bitcoin's volatility are, one, that it's a new asset class, but also that it's built on new technology. It attracts a specific type of inexperienced trader. It halves every 4 years. Influencers and media cover Bitcoin far more than any other currency. Individuals hold a larger portion of Bitcoin by percentage, and of course, stablecoins exist. The number one contributing factor to Bitcoin's volatility is its youth. The first Bitcoin was mined in early 2009. Investment markets take an initial look at a Bitcoin and see risk written all over it. To add to the lack of extensive track record, Bitcoin is also built on experimental blockchain technology, the merits of which are not immediately obvious to larger outside investors. More often than not, the complexity of an untested technology gets filed away as high risk and does not get much attention of investors who manage funds in the multiple billions of dollars. So due to the youth of Bitcoin as a project, large and stable pools of money stay away from Bitcoin, which keeps the price low enough for a different kind of investor to come in and create norms for the way the currency is traded and analyzed. Early on, the type of individuals who were getting into Bitcoin were largely computer programmers and their friends. These types of people understood the potential of Bitcoin but had little to no knowledge of what trading currencies is like, much less how to execute strategies to stabilize a volatile asset. These programmers sat on Bitcoin in some cases years until the price of BTC started to aggressively appreciate in mid to late 2017. At this point, many of the original Bitcoin holders saw that they had turned an initial investment of a few $100s into hundreds of thousands of dollars in Bitcoin. That did what most inexperienced traders would have done. They sold. And when they exchanged BTC to USD, that BTC moved into the wallets of a much more diverse group of traders. While this group is made up of many different types of traders, we know that there is one trait that they all have in common. This trait is that they had some amount of discretionary income to put into a high-risk investment vehicle like Bitcoin. We can then break that trade into two groups: traders who could afford to make that decision and those who could not. A large portion of those who could afford Bitcoin still hold today because they understand what Bitcoin is and what it could be used for in the future. For these more seasoned speculative traders, Bitcoin is just one of many volatile investments that they have made a part of their long-term portfolio. The other traders who bought from these initial holders are much less experienced and likely only bought Bitcoin because they thought they could get rich quick. These types of traders are largely responsible for the volatility brought on by market manipulation. Inexperienced traders often lack the mental fortitude needed to hold a high-risk asset through a cycle of fear. This fact is especially true if they were using money that they unfortunately could not afford to lose. Conversely, these traders are also more likely to take profits long before an asset has fully reflected a favorable event. In short, these traders sell too early and they buy too late. These weaker traders can predictably fall victim to traps that more experienced traders do not. The higher the percentage of inexperienced traders in an asset, the higher the potential volatility can be if a trap or a legitimate event triggers a rapid sell-off or rush to buy. By all estimations, Bitcoin has a history of inexperienced and vulnerable traders holding it. This is just one of the many factors contributing to the volatility of Bitcoin. Another force that can take an inexperienced trader by surprise is called a Bitcoin halving. According to Investopedia, after every 210,000 blocks mined, or roughly every 4 years, the block reward given to Bitcoin miners for processing transactions is cut in half. This event is referred to as a halving because it cuts in half the rate at which new Bitcoins are released into circulation. This can cause volatility to the upside, but as I said before, it's still volatility regardless of the direction of the price movement. Halvings are very important to understand regarding the supply side of Bitcoin, but it is not covered very much by financial media because it's very technically complicated and it happens so infrequently. Like many other profitable phenomena, there are auxiliary industries that spring up to support it. Bitcoin is a cryptocurrency that exists in a larger crypto industry that has innovated on Bitcoin's original blockchain technology to create other cryptocurrencies. Within the very profitable cryptocurrency community, a thriving media industry has grown quickly to serve audiences that demand up-to-date and insightful information on all things crypto. In fact, CryptoJeb, this YouTube channel, falls squarely into the category of a media company that serves audiences interested in crypto. While our team strives to communicate balanced messages about crypto, we are constantly reminded that we operate in a market that does not always prioritize balance over profit. Sadly, heavily biased crypto news is common. Some media outlets even seek to control their audiences by telling them what to think rather than showing them how to think. Alternatively, popular cryptocurrency influencers who may not even be in the media industry can send Bitcoin into a volatile nosedive with a single tweet. An example of this was on May the 12th of 2021 when CEO entrepreneur Elon Musk posted a tweet saying that his electric vehicle company Tesla had suspended vehicle purchases using Bitcoin. 10 days after that tweet was posted, the price of Bitcoin had dropped 39% and did not recover to the May 12th price level for 152 days. This volatility demonstrates how sensitive the Bitcoin market can be to new information from key influencers. I believe that volatility will always exist in markets until we reach a post-scarcity society, so forever. Traders in all major markets have found ways to take advantage of enduring price volatility. After all, the lower you can buy, the higher you can sell. Nevertheless, for most investors, volatility is a sign of high risk and is often avoided at the expense of higher potential returns. Because there's such a diversity of forces that contribute to Bitcoin's ever-changing price, it is not known when Bitcoin will level out and become less volatile. Our team believes that Bitcoin will likely stabilize when traders become the minority of its holders and everyday people begin to use it to buy ordinary items at ordinary stores. After all, Bitcoin is designed to be a means of exchange and not a speculative asset to be traded. Until that day, people all over the world will continue to eagerly buy Bitcoin, and I will be one of them. Hey, you made it to the end of the video. If you enjoyed this video, you should definitely consider subscribing because we're trying to help you become financially free in these cryptocurrency markets. And also, consider following us on Twitter @CryptoJeb for more updates on the price of Bitcoin and cryptocurrencies. Peace.